What a downbeat forecast for 60/40 portfolios means for alternatives. JPMorgan Asset Management is forecasting returns for a 60/40 US stock bond portfolio to fall 10 bits per second to 5.4% and believes investors will have to explore alternatives to add income, although not all investors are on board with the asset manager's suggestion that private equity is a good fit for clients with a high risk tolerance. The asset manager's latest long-term capital market assumptions, which predicts the fate of asset classes for the next 10 to 15 years, urges investors to rethink their asset allocation, especially to fixed income, in a world of ultra-low bond yields and modest global growth. Speaking at a JPMAM Market Outlook event, Chief Market Strategist EMEA Karen Ward, pictured, explained central banks will have to work considerably harder to get nominal growth to a desirable level while the signs for inflation that usually signal the end of the cycle are still relatively absent. Investors can do better than the forecast returns on 60/40 portfoliosJPMAM's projection for global CPI over the next 10 to 15 years is 2.2% and it expects real global growth to average 2.3% over the period, down 20 basis points, BPS, from last year's forecast. It cites aging populations as a key headwind, while a technology-driven boost to productivity represents the main upside risk. That does leave us in this lower for longer environment, and that's a tremendous challenge for fixed income returns, Ward says. Stocks, therefore, look considerably more attractive in terms of returns. JPMAM is optimistic on global stocks over the next 10 to 15 years, predicting the average return to rise 50 bits per second from last year's prediction to 6.5% in US dollar terms. The forecast for developed markets is 5.7%, and for emerging markets it is 8.7% in local currency terms. But returns are expected to be muted compared with long-term historical averages. US equity, for example, saw a 9.8% average return over the past 25 years, almost double JPMAM's prediction of 5.6% over the next 10 to 15 years. We just have to do better than that, 60/40, Ward said in response to the 5.4% predicted returns for such portfolios. We have to add in other alternative asset classes in order to make sure we're delivering the best risk return we can. Private equity touted for thematic exposure. JPMAM head of global multi-asset strategy John Bilton believes private equity in particular may offer a better environment for innovation and growth, and the firm's 10 to 15-year aggregate return forecast has been raised 55 bits per second to 8.8%. JPMAM argues the asset class continues to be attractive to those investors looking for return uplift, as well as those seeking more specific exposure to technology themes. If you want to push out a bit further along the risk spectrum, it's the alternative financial markets, which actually hold up relatively well. For more on this story, visit the news article link.